Today, we're diving into building long-term wealth and passive income through dividend investing. Dividend investing is one of the smartest strategies for anyone looking to grow their money, regardless of age. It's all about getting paid to own a piece of great companies, businesses that generate profits, and share a portion of those profits with you. Stick around and you'll learn how to create a portfolio that generates a steady stream of passive income for years to come. Okay, before we get into the good stuff, let's start with the basics. Dividends are payments made by companies to their shareholders, usually from their profits. These payments are typically made in cash and distributed quarterly. Not all companies pay dividends. Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These are the blue chip companies that have been around for decades, paying dividends like clockwork. Alright, now that you understand the basics, let's talk about why you should care about dividend investing. Dividend-paying stocks provide a predictable stream of income, which can be especially attractive to retirees. That extra income can be reinvested, supercharging your returns. When you reinvest your dividends, you're essentially buying more shares of the company, which in turn generates more dividends. It's like a snowball effect that can grow your portfolio exponentially over time. Now, building a solid dividend portfolio takes some work, but it's not rocket science. Focus on companies with a healthy dividend yield and a track record of increasing their dividends over time. Pay close attention to the payout ratio, which is the percentage of earnings paid out as dividends. A healthy payout ratio is typically below 60%. You want companies that can comfortably afford to pay their dividends while still reinvesting in their growth. Listen, dividend investing isn't foolproof. One of the biggest mistakes is chasing high yields without doing due diligence. A sky-high dividend yield can sometimes be a red flag, signaling a company in distress. Always investigate the company's financials and make sure the dividend is sustainable. Minimize costs by using a low-cost brokerage, considering index funds or ETFs, and taking advantage of tax-advantaged accounts like IRAs or 401ks. Using dividend reinvestment plans, DRIPs. DRIPs automatically reinvest your dividends to purchase additional shares of the company, compounding your investment without you having to lift a finger. It's a set-it-and-forget-it strategy that's perfect for long-term investors. Instead of getting a cash payout every quarter, those dividends are immediately put to work buying more shares. When to expect results? Let's be real, dividend investing isn't a get-rich-quick scheme. Building a substantial income stream from dividends takes time, patience, and discipline. Focus on building a diversified portfolio of quality companies, reinvesting those dividends, and letting the power of compounding work its magic. Over time, as your portfolio grows and those dividends compound, you'll start to see significant progress. The bottom line. Dividend investing is about finding the sweet spot between income today and growth for tomorrow. By carefully selecting strong, reliable companies, reinvesting your dividends, and staying disciplined, you can create a portfolio that works for you for decades to come. Do your research, invest for the long term, and don't be afraid to seek guidance from a financial advisor if you need it. Start investing today. So there you have it. Everything you need to know to get started with dividend investing. It's about finding quality companies with a history of paying dividends and letting your money work for you. Even if you can only invest a small amount each month, the power of compounding will work its magic over time. Start today and let your money earn for you while you sleep. If you liked this video, hit that thumbs up. Until next time, happy investing.